Welcome back to Chapter 2 of Real Estate Investing 101, where we're diving into our episode titled The Numbers That Matter: How to Analyze a Deal. Today, we'll unpack the essential calculations you need to determine the potential cash flow of a property, setting you up for success in your investing journey. So, let's get started. 80% of new investors admit they buy properties based on gut feelings, not hard numbers. You're standing in a crowded open house. Fresh paint, staged furniture, friendly agent. It feels right. But here's the twist. One hidden number can quietly turn this deal into a drain. That's where the core deal metrics come in. Before you worry about paint colors or upside, you need to know what the numbers are actually saying. In this episode, we'll break down the 6 metrics that experienced investors lean on: net operating income, NOI, cap rate, cash-on-cash return, debt service coverage ratio, DSCR, internal rate of return, IRR, and plain vanilla ROI. These aren't theory. In Q1 2024, U.S. multifamily traded at an average cap rate of 5.3%. Most commercial lenders won't even quote you a loan unless your DSCR is at least 1.20 to 1.35. And a simple 1% jump in interest rates can slash the cash-on-cash return on a 75% leveraged deal by 2 to 3 percentage points. You don't need fancy software either. 80% of small investors still use spreadsheets. What you do need is to learn how to plug in the right numbers and interpret what they're telling you. On a real deal, these metrics stop being theory very quickly. Take a small 8-unit building. Each unit rents for $1,400, so gross scheduled rent is $13,600 per month, or $163,200 per year. After vacancies and operating costs, you might land at $90,000 in annual NOI. If the seller wants $1.7 million, that's about a 5.3% cap, right in line with recent U.S. multifamily averages. Put 25% down, $425,000, and finance the rest at today's rates, and a 1% change in interest could swing your cash-on-cash return from 9% to 6 to 7%. A big shift on the same address. Now let's layer these metrics onto that 8-unit example so you can see how they actually drive a decision. Start with the seller's $1.7 million price and $90,000 NOI. The 5.3% cap tells you this deal is priced right around the broader multifamily market, but it doesn't tell you if the cash flow works for you. Suppose you get a 75% loan. $1,275,000 at 6.5% interest, 25-year amortization. That's roughly $103,000 per year in principal and interest. Suddenly, a key problem appears. $90,000 NOI cannot cover $103,000 in debt. Your DSCR is about 0.87. No commercial lender will touch that, and you'd be feeding the property from your pocket. So what has to change? Option 1. Lower the price. To hit a 1.25 DSCR with that same $103,000 debt service, you'd need about $128,750 NOI. At the current $90,000, you're short nearly $39,000. If the market won't support higher rents or lower expenses, the only lever is price. At $90,000 NOI and a 7.0% cap, the price would be about $1.29 million, a massive discount from $1.7 million, but now NOI covers the debt at today's rates. Option 2. Improve the operations. Assume market rents support $1,550 per unit instead of $1,400, and you can trim bloated expenses. New gross rent, $1,550 times 8 times 12 equals $148,800. If you can operate at, say, 40% expense ratio, including vacancy, NOI becomes roughly $89,000. Not enough. To get closer, maybe rents can go to $1,650 and you tighten expenses further. At $1,650, gross rent is $158,400. At a leaner 35% expense ratio, NOI is about $102,000, barely above the current debt service. That's still under a 1.0 DSCR once you factor in real-world hiccups. Now look at cash on cash. Say you somehow negotiate to $1.5 million, still 75% financed. Your down payment and closing costs total about $400,000. If after all expenses and debt you clear $32,000 a year, that's an 8% cash-on-cash return. Raise the rate from 6.5% to 7.5%, and your annual debt might climb by $12,000, chopping that return to roughly 5%, on the same building, same tenants, same rents. Finally, think about IRR and overall ROI over 5 to 10 years. Mild rent growth and some principal paydown can turn a mediocre 5% year-one cash-on-cash into a solid long-term IRR, but only if you are not bleeding cash today. Negative cash flow plus optimistic appreciation assumptions is where small investors get wiped out. Numbers first, story second. The metrics tell you whether the story is even believable. An easy way to pressure test these metrics is to line up two real deals side by side. Deal A, a fourplex listed at $620,000, bringing in $5,600 a month in actual collected rent. Operating expenses plus vacancy average 45% of income, and the existing owner's records show stable costs for 3 years. After expenses and your new mortgage, you're left with about $8,000 per year in before-tax cash flow on a $160,000 total cash outlay, down payment plus closing and initial repairs. Deal B, a shiny turnkey single family at $420,000, renting for $2,750 a month. Broker pro forma claims low expenses, but taxes just reset. Insurance quotes are 20% higher than last year, and there's an HOA at $260 a month. Under realistic expenses, your annual cash flow is closer to $1,200 on $110,000 invested. On paper, both cash flow, but when you compare the actual dollars left in your pocket against what you invested, Deal A quietly puts $8,000 to work every year, while Deal B barely nudges the needle. As real-time data spreads, sloppy underwriting gets punished faster. If you can instantly compare a seller's numbers to live market averages, say insurance at $1,800 versus a local norm of $2,450, or taxes at $4,200 versus a post-sale estimate of $6,000, you'll spot deals that only work on paper. Your challenge this week: take one live listing and rebuild its numbers using current tax, insurance, and rent data from at least 3 independent sources. Then ask, would you still buy it? As you review deals, set hard numeric floors, maybe DSCR 1.25, cash on cash 7%, and at least $150 UINI a month in projected post-debt cash flow. If a property misses even one, it's a pass, no exceptions. Over 10 screened listings, expect 7 to 8 to fail fast. That's success, not failure. Every no clears space for the one deal that actually hits your numbers. To go deeper, here are 3 next steps. 1. Grab the free BiggerPockets Deal Analyzer or their deal analysis spreadsheet and run the exact numbers from one property you're currently watching. Plug in purchase price, realistic rent, cross-check with Rentometer or Zillow, taxes, insurance, and maintenance at 8 to 10% to see your true cash-on-cash return. 2. Watch AJ Osborne's or BiggerPockets YouTube walkthroughs on cap rate and cash-on-cash return, then pause and calculate those same metrics for 3 recent sold comps in your target market using Redfin or Zillow data. 3. If you want a deeper foundation, Read the chapters on deal analysis in The Book on Rental Property Investing by Brandon Turner, and as you go, rebuild his example deal in a simple Google Sheet so you can reuse that template for your own next deal. This was Owl Up, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!